One of the most tired cliches you hear in markets commentary is that the stock market is not the economy. Except, is this really true? Paul Dietrich is the CEO and CIO at Fairfax Global Markets. Joins us now to discuss this and many other things. But Paul, it jumped out to me that you take on this issue right at the top of your note, because I kind of think, like you do, that the stock market and the economy, they're pretty closely connected, and over time they sort of follow the same trajectory. So to that point, we've seen the stock market rebound very sharply over the last couple of months, while manufacturing data today, other data points indicate the economy is slowing. What's your read right now on where the economy is and how the market has reacted to that?
Well, you're absolutely right. In the long term, the stock market reflects the underlying directional trend of the underlying economy. If it's going up, the stock market's going up. If it's declining, the stock market is declining. But in the short term, all sorts of things, politics, trade talks, Fed policies can affect it. And we saw that in October and November. We're going to celebrate this month the 10th anniversary of the longest and largest bull market in history. But the question I think that every investor wants to know is, when will it end? We are continuing to grow and expand, but I'm seeing a slowing. And I watch leading economic indicators. As an investment manager, I try to keep my clients fully invested in the market during bull markets, during economies that are expanding, and I try to get them out when we're declining. And I did that in 2000, 2002, 2008, and 2009. And the way I did it was following these leading economic indicators. These are the indicators that go down before the economy goes down. And so I track them weekly, and I overlay them on how they were back in 2000 or 1999 and 2006 and 2007. And what I'm seeing now is we've gone up. We're starting to slow, but we're still growing. At some point, we will plateau out and go sideways and then decline. We're going to have a recession at some time. It's part of the economic cycle. And as I track where we are right now with what happened in the past, I think we're 14 to 18 months away from a recession. So mid next year to late next year. But don't panic, because I wouldn't get out of the market right now, because I think this year is going to be really good.
So, Paul, if you're looking for a recession 14, 18 months, are you looking at a bear market later this year? Do you see Dow 20,000? How should investors play this? Well,
right now, there are two trends that I find very bullish. Today, FactSet came out with the earnings for last year, which was S&P 500 average earnings were 20%. Now, on a normal course, if you had after-tax earnings of 20%, the stock market should have been up 20%. And we all know it was down for the year. Whenever a trend gets out of whack in the short term, there's something called a reversion to mean, a reversion to trend. And we're seeing that right now. I mean, we're up almost 12% in the first 2 weeks of this year. And the analyst estimates right now that came out today is that we're going to see another 10% from now for the next 12 months. We could easily see a 20% gain at the end of the year. Now, will there be another correction? We had two corrections last year. We had one in the early part of the year and the big one at the end of the year. Yeah, and it'll probably be some political issue that will come up. Maybe it's impeachment. Maybe it's something else. But that will be a correction, not the economy will still be growing and expanding.
It's not a meltdown.
It's not a meltdown, and I do not believe that's going to happen this year.
Talking about the reversion to the mean or reversion to trend, talk about FANG a little bit in here. We were just talking about Amazon, which is up today, but when you look at it, take it back 3 months, the NASDAQ's up and Amazon is still down. What do you expect to happen to some of the big cap tech names that we all, kind of grew to know and love? They got you to the dance. Did you go back to them?
There's some long-term trends. I'm not a trader, so I'm not getting in and out of the market on whether they're buying a grocery store or not. But you look at the long-term trends, And I see two, artificial intelligence and the cloud. And in artificial intelligence, you've got Google, Microsoft, and Apple. And these are the people who are going to take artificial intelligence because of 5G. That's going to be the initial catalyst. There's lots of research in artificial intelligence, but the stuff you're going to see right away in apps is just going to be magnificent next year when 5G starts to roll out. I mean, they talked about that you'll have 20 times faster streaming on phones, but actually 5G allows for 100 times faster. It's just we don't have the equipment yet to do that.
How fast can I watch an episode?
You can download a movie. You can download a movie in 30 seconds. But I've watched it in South Korea. They've had it for 3 or 4 years. You cannot believe what the apps do over there. And the cloud is indirectly, and Amazon and Microsoft are there. And I think that a lot of these tech companies, they're going to be coasting a bit this year. I mean, why would anyone spend $1,000 for an Apple iPhone for 4G when 5G is coming out next year? But in 2020 and 2021, you are going to see an explosion in all of these companies. I mean, think about it. Every iPhone in the world and every Android in the world is going to have to be replaced in that 2-year period. The revenue and the earnings are going to be unbelievable. So you have to buy now. I mean, Apple's selling for 13 PE today, forward PE. It's a value stock, and you know that this is going to happen. We know 5G is coming in. Why wouldn't you buy it now? And the same, I think all these other tech stocks they're fairly valued. Apple is undervalued. Get them now, hold them, and you're going to see this big boost.
All right, Paul Dietrich, Fairfax Global Markets. Thanks for joining us. A lot of fun.